Hello, my name's Paul Conrad. I'm a CPA in Richmond, Texas. That is in the suburbs of Houston, Texas, about 25 minutes away. If you're watching this video, this is the first of what I hope is going to be a series of videos. As a CPA, I specialize in tax return preparation and tax strategies for people who own their own business. I've been in business for myself for probably about 16 years or so, either in business for myself or some of the time I had a partner. But I've been preparing taxes for a long time, and over the years I've evolved to the point where most of my clients are actually in business for themselves. Probably, I'd say 80 or 90% of the people that I have are in business for themselves some way. Maybe it's they own a business, maybe it's a bunch of real estate investments that they have, something like that. And the challenges for people who are in business for themselves are different than a lot of people, and that's just what I've gravitated to. And hopefully I'm going to put together a series of videos to kind of go over some of the more common things that I think that people who are in business for themselves, that what they encounter. A lot of clients come to me. They're referred by an existing client. They walk in the door. I'm doing a face-to-face meeting with them, and a lot of times they say, I don't know anything about being in business for myself from a tax perspective, so assume I don't know anything, teach me something. And I'm really glad when someone says that, because I've done this enough where I know that there are surprises out there that people who are going into business for themselves, they don't even know enough to ask that question, and then they're surprised and shocked and sad and angry and why didn't someone tell me and stuff like that. So that's going to be the topic of this first video is what is the tax situation when you go into business for yourself. But before we do that, let's talk about what was your tax situation when you work for somebody else. You were an employee, because that actually has that's a good foundation for what it's like in the tax world to be in business for yourself too. So let's assume that you work for someone else. You're an employee and you get a paycheck, and at the end of the year you get a W-2. And you use that W-2 and other things to prepare your annual tax return. Well, when you were paid along the way, and let's draw kind of what looks like a paycheck, I suppose, or at least part of it anyway. Your paycheck always had some gross amount. And let's say that for some time period you earned $1,000. I hope you can see this on the video, okay? And you had certain taxes that were withheld from it. What I might say, federal income tax. It might have had different acronyms or something, but you always had federal income taxes. Let's say that's $100, deducted. Nobody likes that. And then you had what I'm going to call Social Security taxes withheld. Now, your paycheck might have said FICA, it might have said Medicare, it might have said, had some other titles for it, but in my world, we just kind of call that the Social Security tax. And you had some of that withheld, and that would, in this case, be about $76 or so withheld. And maybe you had some other taxes along the way, and at the bottom, you had a net check down here. And this is kind of what you thought you got paid. This is what you had to live on, okay? With regards to the income tax, you complained about it, but you thought about it in the sense you kind of hoped, I hope that's enough so that when I do my tax return at the end of the year, I don't owe anything. I really hope that's too much so that when I do my tax return, I get a check back. Wouldn't that be nice? Well, kind of nice to get a check back. So we complain about it, but it's kind of in the back of my mind. Is it enough or not? This Social Security tax right here, you kind of complain about it, but then you never really think about it after that. You don't think, gee, I wonder if my employer withheld enough and I'm going to have to pay more. I wonder if they withheld too much and I'm going to get some of that back. And you don't really think that very much. You kind of go, darn it, oh well, and then you kind of move on and you focus more on this income tax or maybe some of the other deductions that are happening. But The reason I go through this is to kind of put on your radar screen that there's these two taxes, at least two taxes that are happening on this tax on this paycheck, and maybe a bunch more. Maybe there's state income taxes and disability insurance taxes and stuff like that. But these are the two big ones right here. There we go. And when, again, at the end of the year, you fill out an income tax return, and you're really monitoring that one right there. And this one kind of goes off into a black hole, and you go, I guess I get it back when I retire. That'll actually be a topic for another video. But you don't really think about that one so much. Now, what you may not realize is that this amount is a certain percentage of that. FICA is, as I'm making this video, I'm not going to say it's always going to be this percentage, but at the moment, FICA is 6.2%, and Medicare is 1.45%. FICA, they stop withholding that when you get to about $120,000, and then it stops. This Medicare goes on for as long as you get paid. There's no limit to that one. So these two together are 7.65%. So you notice $76.50 is that percentage times that dollar. So if you thought it hurt, 7.65%, and you don't know where it went, you don't know when you get it back, if you think it hurts, the reality is that's only half the story. What happens on this particular tax is that your employer matched this $76, and roughly $150 or so got sent off to the government with your name attached to it. Now that money doesn't go into a separate bank account, but they kind of do a separate accounting, and they say, Susie or Paul or whoever you are, had $76.50 of employee portion of the Social Security, and then the employer matches that. And there's another $76.50. And these two portions, the employee portion and the employer portion, get matched together, and your employer puts them both together and sends them off to our federal government. So if you think that 7.65% is a lot, the reality is that was only half of the tax. And as an employee, you're kind of lucky that you have the employer who pays that other half for you. A lot of you know that, a lot of you don't know that. But this is a kind of a basis for what's going to happen when you're in business for yourself. So kind of remember this. I'm going to erase this here for a minute. Now that's what happens when you are the employee. You have this employee and this employer portion of this Social Security tax, and you have the income tax. So you have these two fairly large taxes that you're worried about. Now you decide, I don't want to work for someone else anymore. I'm going to go into business for myself. I can do this better. I can make more money. Give me more freedom. Whatever your reasons are, they're valid reasons. You go into business for yourself. So you don't have an employer. She is not giving you a paycheck twice a month or every other Friday or whatever that happens. You're not getting that. But basically, your customers, your clients are paying you kind of whenever, you know. I get paid more during the tax season because I do more tax returns. But I have some dry times where the money doesn't flow so much and I have to budget my money. But the money just kind of comes in sort of haphazardly in a little bit, in a sense like that. So you have to manage your money. But in a sense, so let's talk about the person who, now you're self-employed, so you're not getting that paycheck. So we're going to draw, my pen's not working very well. Let's try another one here. Let's see if this one works a little better. I think that shows up on the video. Okay, so here's our taxpayer. And we'll give our taxpayer some legs and some arms. And they're not really quite sure what's going on here, so they don't have a smile on their face yet. But they've gone out, and maybe they're a real estate agent, repair cars. Here in the Houston area, we have a lot of people who are consultants in the oil and gas professions and so on. But whatever it is, it could be anything really. But you're in business for yourself, and you've gone through the whole year, and you've collected some money, you've paid some money out, you have a profit left over. How does that profit get taxed? Let's draw some forms up here. The main form that most people deal with is called the 1040. I'm assuming you've probably heard that number, seen that form, something like that. This is where most of it's kind of a summary form. This is where everything from all the other forms get brought together. This is where all the calculations kind of take place in a sense. And there's a separate line item on here for when you get a W-2. There's a line item specifically for that. But we're not going to use that one right now. There is a separate line item, a different line item for when you're what's called a sole proprietor. That means you've gone into business for yourself. You haven't formed a more official company like a corporation or some LLCs, not all of them, or maybe there's a special kind of corporation called an S Corp, and there's limited partnerships, and there's actually quite a variety of these different kinds of companies that you can form. Most states have what's called a Secretary of State, a State Department that you form these kinds of things. But you don't have to do that to go into business for yourself. You can just go into business. Kind of hang out a shingle, they say. I'm now in business as a CPA tax return preparer, something like that. When that happens, there's a separate form called Schedule C. I think this actually says sole proprietorship or something like that at the top. But in my world, we just say he's a Schedule C person, and we know what that means. There are line items for what I call revenue. It might say expense. I might say income. Actually, income and expenses are kind of synonymous. There are line items for different kinds of expenses, and I put a bracket around because you deduct those. And there is what's left over is called the profit. And this all happens on this form. There's actually a second page to this form. By the way, people go, what categories or what accounts should I use to accumulate my expenses? And I say, use whatever you want to do. The form is designed where there are some common line items for the more common types of expenses. Maybe it's rent, maybe it's salaries or utilities or insurance, something like that. But the back side of this form, there's an overflow section where you can put down any title you want to. And I use that overflow a lot. My clients who are real estate agents, their expenses for their kind of profession are different from the people who are in oil and gas or repair cars or put together websites or whatever they do. So there's no standard list of accounts. I tell people, use the accounts that make sense to you. I can make it work on the tax return. Revenues is just a number. How much did I bring in? And for the most part, you say, I brought in X amount of dollars, and that's kind of all the form asks for. The expenses, though, have to be broken down into categories. And if you come to me and say, my income is $100,000 and my expenses are $40,000, I'll say, that's nice to know, but you're going to have to categorize those expenses in the titles that will fit on the form, or that I can fit them on the form, okay? But let's say you've done that, and in this particular example, your profit is $60,000. You've had no taxes withheld from this at all. You've just gotten the $100,000. You've paid out the $40,000 out of your bank account, and the $60,000 is either still sitting there, or you've drawn it out, put it in your own pocket to pay your own mortgage and buy Christmas presents and take vacations and groceries and stuff like that. Okay. So you have a profit. You don't have any taxes already paid. There's no paycheck. There's no W-2. There's nothing like that. So how is that $60,000 taxed? Well, it's going to go to two places, actually. And this will make sense in a minute. The 60 grand falls down onto here. I'm not going to write a number. And there's an income tax calculation that goes on. No big surprise there. How much is that income tax calculation? Well, it depends. Are you married? You're single, you own a home or not, you have kids or not, you give to church and charity or not, maybe you're a student, maybe you did any of 1,000 other things that could affect what that calculation is. So what is the tax on $60,000? What is the income tax on $60,000? I can't really tell you. But I'm going to say this person, let's say they're not married, they have maybe a child, maybe they've been able to buy a home, something like that. And all those, being married and having kids, having a home, being charitable, all those things help to reduce the income tax. And on that 60 grand, this person might owe, I'm going to say, $3,000 of income tax. That's really not bad. 3,000, I know it sounds like a lot, but 3,000 compared to 60,000, that's only 5%. That's not a bad tax, really. Of course, you have to come up with it all at once sometimes because you didn't save for it, but that's another story. What I said a minute ago, this goes to a second place. Well, what's that second place? Well, there's a secondary form called Schedule SE. This is a very important form. SE actually stands for self-employment. Let's write that down because people ask me that a lot, and I hope I'm writing large enough that you can actually see this on the video. Self-employment tax. What in the world is self-employment tax? I wish our government didn't do this, but what they've done is they've changed the name of Social Security tax when you're an employee to self-employment tax when you work for yourself. It really is Social Security tax for self-employed people. That's what it really means. So if you hear someone say self-employment tax, in your mind you could reverse that and say, oh, that's Social Security tax. Or if someone is in business for themselves and they go, I don't pay Social Security tax, but I don't even know what this self-employment tax is. If you've heard this video, you know they're interchangeable, and the person who said that really doesn't understand what's going on. But you could think that Social Security and self-employment tax are really the same thing. So this $60,000 profit actually comes down here. I'm going to write 60,000. Now remember, when you were the employee, let's go back to the beginning of the video, and you had some FICA and Medicare withheld, collectively we'll call that Social Security, and it was 7.65%. I kind of say 7.5. I do a little bit of rounding because it will make the math easier here in a minute. But you had about 7.5% withheld, and that employer kicked in the employer portion, and together 15% was sent off to our government on your account. Well, who's the employer? Who's the employee in this scenario? I've only drawn one person. This person, you or your neighbor or whoever, are both. You're both think of yourself as the employer and the employee of your own business in this kind of situation. So while you have the freedom to run your business any way you want to, you also have the obligation to pay the employee and the employer portion of that Social Security tax that we highlighted on that paycheck a little while ago. Well, 7.5% roughly employee tax, 7.5% employer tax, 15%. This form says we're going to multiply this profit times 15% because we want the same 15% even though there's no employer paying that other half for you. Ouch. 15%. Ouch. That's why I do this. I want you to understand how Social Security works so you'll understand how this self-employment works. Now the reality is you get about a 1% discount on this form, so it really doesn't end up being 15%. In reality, it's closer to about 14%. But I'm going to multiply this by 14%, and I think you end up with about $8,400 if I'm doing my math right in my head. So think of that. It's titled self-employment tax, but think of that as Social Security tax. And this number, then it loops back on here, and I'm going to call it Social Security tax. Let's make this $3,000. That's our estimate, and this is $8,000. 400. So you're cresting on $12,000. Something like that. That is a lot of money compared to that $60,000. I mean, that's over, that's like 20%, almost. And what's interesting is for a lot of people in these kinds of numbers, they actually pay a lot more in Social Security or self-employment tax than they're paying in the income tax. So I'm glad I'm doing this video. I hope you're watching this. I wish everybody in the whole United States who goes into business for themselves would watch this video, because this is the shock for everybody. I can't tell you how many people say, I had no idea. Not only this employee-employer portion of Social Security, certainly I knew the employee portion, I saw it on my paycheck, but I go into business for myself, and now I got to pay both halves. And it just never dawned on me that I still had to pay that Social Security tax, and you do, and it hurts twice as much. Ouch, ouch. I hope this is sinking in. And really what I want you, if you're just going into business for yourself, I think it's valuable to do a little bit of math and go, how much do I think I'm going to make? Or maybe as the year is progressing, how much have I made so far at different points? Maybe every 3 months or so you have an accounting program like QuickBooks, or you build your own Excel spreadsheet. That works too. But keep track of your income, keep track of your expenses. Try to have a separate bank account for your business, and try to get a credit card. It can be in your own name, but use it just for business. And that'll help you consolidate all your bills so that you can figure out what these expenses are right here, and kind of do this throughout the year. Everyone does it at the end of the year, and they're surprised at what this tax bill ends up being. But you would be well served to do some of this accounting throughout the year and figure out, at a minimum, this is really a big question. How much should I set aside when I make a profit? How much should I set aside to pay my taxes? And when I go through this and I say, whatever this profit is, you should set aside at least 15%, and that's just for the Social Security tax. That doesn't even cover the income tax. The income tax, depending on how big that number is, it could be as low as 0 to 5%. But I have clients who are in the 33, 35, 40% range. I'm doing a little rounding on that one. But 40% and another 15%, you're talking like I got to set aside half my income to pay my tax bill. Combine the income and the Social Security. Oh my gosh, why did I even go into business for myself in the first place? Now, I can see the wheels turning when I'm sitting across the table from some certain clients. I hope this makes sense to you. Remember, there is a Social Security tax when you're in business for yourself. Don't forget that. Now, a topic for a different video, how can you reduce some of these taxes? I'm running out of time, so I don't want to take away too much time for that. We're going to make a separate video for that one. But I do want to talk about how you pay that almost $12,000. Imagine a client comes in, they're kind of nervous, first year they're in business for themselves. I go through this calculation and I go, you owe 12 grand, and they're downcast and depressed, and they go, gosh, I wish I had seen you a year ago so you could have explained this to me, so I could have saved for that. And I say, well, so I got to write a $12,000 check, and I go, well, really, it's going to be more than $12,000 now that. Okay, explain that to me. Very quickly, when you have a paycheck and taxes are withheld, your employer collects those, they're a collection agent, and they send those off to the government for you. So you don't worry about, you don't send any money to the government, at least you hope not, even when the tax return's prepared. But when you're in business for yourself, that mechanism isn't in place anymore. And what happens is you actually have to write a check, or you can go online, and you send money to the IRS. I do this. Most of my clients have to send money to the IRS, and we call this quarterly estimated payments. Quarterly estimated payments. Ooh, ESTI. What this means is the IRS, and they haven't come up with, they call it quarterly, but they don't do it quarterly. That's our government. But April 15th, June 15th, so there's only 2 months difference between that, and then September 15th, and another 3 months, and then January 15th of the next year. So that's 4 months in between that. So we call it quarterly, but it's not quite quarterly. But our government expects that if you're going to owe 12 grand, they expect you to send in $3,000 about every 3 months, so that when your tax return is prepared, you have $12,000 just sitting on account waiting for the tax return. And if you sent them 12 grand and your tax bill is 11,000, then you got a decision. You can have the 1,000 sent back to you as a refund check. Most of my clients actually leave that 1,000 on account because they got to make estimated payments the next year, year 2. Well, why get a refund check and send them a check back? Why send them a check and wait for a refund check? Sometimes that happens. So a lot of times we leave that overpayment on account. But let's say this is your first year doing this, and your tax bill is, it should have been 12 grand, and you haven't paid any of these payments, and maybe you're seeing me on or around April 15th of the next year. Maybe you've put your return on extension, and you're not coming around until 6 months after that. So this is year 1, this, and this is year 2. So it was a long time from when they expected to get your money versus when you might have been paying it down here. Well, there's no free lunch with the IRS. They will charge you interest. They call it penalty, but they're going to charge you interest on this $3,000 from the day it was due till whenever you pay it. So there's an interest calculation. Let's say you pay it here. There's an interest calculation on 3 grand for, 18 months. Then there's a second interest calculation, call it penalty or whatever, from June to October, so July, August, October. So that's 16 months. 18 months, 16 months. This one is going to have, 13 more months. This one is going to have 9 months. And you add up these 4 interest you add them all together, and it might add another $1,000 or so in interest. So you're not writing a $12,000 check because that's what you owe, but our government is kind of funny. They don't want it all at the end of the year. They say, we got bills to pay throughout the year too. We want the money throughout the year. It's not against the law to pay your tax all at the end of the year, but if you do, just know that there will be penalty or interest added on. That's just the way it is. That's the end of the time that I have for this video. I hope you've learned something. I hope you've enjoyed it. Be on the lookout for other videos that I'll have. And if you're in the Houston area, or even if you're not and you don't mind long distance relationships, emails and phone and stuff like that, I have a lot of clients. I haven't seen them in years, but we talk all the time. We email all the time. If you're interested, look me up. I have a website, paulconradcpa.com, and I'd love to hear from you and just be on the lookout for more videos. Thanks for your time.